5 a.m. in New York City, 10 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg brief. Let's get you set up for the day. Futures wavering after the Mag 7 suffered their biggest one-day drop since the tariff-driven sell-off back in April 2025. Fresh U.S. levies take effect on goods from 60 economies as President Trump rebuilds his tariff wall. And Brent crude below $100 a barrel now, having topped 100 as President Trump says he's mulling a massive attack on Iran. Let's check in on markets around the world. Asia closing out an eventful week. Winnie Su is in Hong Kong with the latest. Winnie.
Yeah, good morning, Bonnie. Well, it is a risk-off day in Asia as we head into the weekend amid these geopolitical tensions, and still oil remain at elevated levels. Now we have the MSCI Asia here down more than 2% after 3 days of gains. It is the tech really leading the declines today as concerns are still really around how these massive spendings of U.S. hyperscalers are going to weigh on sentiment. We have South Korea's Kospi index today leading declines in Asia. Now flip aboard, we'll take a look cross asset when it comes to Japanese markets, because it still is those inflationary risks and also the higher U.S. dollar weighing on the Japanese yen as it weakened overnight to inch closer to that 164 level against the dollar. Now it is also on track for its worst week in more than 2 months. Now when it comes to the bond yield space, we are looking at similar impact because we have the 40-year bond yield leading gains across maturities up about 10 basis points, while the 5-year is also hitting a record since its debut in 2000. The concern really is that the Bank of Japan might be too slow in tightening the policies to tame inflation. But for now, the expectation for the policy meeting next week is still for a hold.
Yeah, and that yen very close to up one more big figure, Winnie, very close to 164. Winnie Su there in Hong Kong. Now to London, where beyond all of that, markets have also been digesting that ECB meeting and new leadership in Britain. Here's Louise Moon.
Good morning. As we're saying, roughly broadly higher across the European space. You can see the stocks Europe 600 just slightly into the green, potentially ending that week there into the green, boosted largely by tech and by financial services. So tech on the back of SAP earnings, coming in stronger on the back of their cloud, easing some concerns there to do with AI, and that is boosting tech across the board. And then we've got financials, you can see up just over 1% there on the back of this higher for longer rate story boosting banks across Europe. And then a quick look at the German bond yields. This is a story we've been seeing playing out across Europe this week. It's been a tumultuous week as, on the back of this higher oil prices, easing slightly today that we can see, just easing there. So we'll be keeping an eye on that one throughout the day.
Yeah, those yields in Europe have really been shooting higher, as they have around the world, including in the United States. Louise Moon, thank you so much. Interesting to hear Louise talk about the positive tech story, because of course we had a sell-off in the Nasdaq yesterday, a pretty dire one in fact, down 1.9% as things go. I mean, if 2% is dire. Today we might get a little bit of relief because we are seeing Brent and New York crude trade a little bit lower. Brent having topped $100 a barrel, now is just above $97 a barrel, even though we got word from Iran that New York Times report that suggested Iraq had sent some kind of mediator or mediation request, that wasn't actually true. Either way, headlines keep coming and the market keeps digesting them. No relief really though for European gas futures, still above 62 euros per megawatt hour. Let's take a look at futures, because obviously we've had an up-down week. Intel with great earnings, SAP, as Louise mentioned, with great earnings, and we are starting to see the Nasdaq creep into positive territory. Futures really were wavering between losses and gains earlier on, and it looks like very tentatively we might be having a positive day off the back of some of those tech earnings. Nevertheless, the broader tech sell-off does still seem to be a little bit intact. And yields-wise, well, we're seeing a phenomenal picture in yields. The 30-year yield is at 517, basically. We had another, not failed, but weak demand auction yesterday for 20-year tips, and that was just yet another sign that the appetite isn't there for longer-dated yields. Look at the 2-year, 432. We have shot up in just a few sessions to 432.85, and we're just down 2 basis points, so we were even higher than that. The 10-year yield as well topped 470 in yesterday's session. Really a phenomenal move in yields. But central banks obviously digesting the potential inflationary impact of oil, whether it's right above 100 or just below 100, it doesn't really matter. The VIX also yesterday topped 20. We're a little bit off that now. Okay, let's get to some individual market movers, and for that we'll go back over to London and Chloe Melly.
Good morning, Bonnie. We are seeing Intel shares up this morning about 4% after their revenue forecast came in way ahead of expectations. This indicates sustainable, strong AI demand and really reassures investors on both this AI demand but also this turnaround from Intel, which seems to be paying off. Moving on, but staying within tech, and we've got MaxLinear this morning down after the results actually came in ahead, but only modestly ahead of expectations. So that was not just quite enough to really sustain the impressive rally that we saw in those shares over the start of this year. And finally, Amkor is also down this morning. Up this morning, up 10% after signing a multi-year partnership, $1.5 billion partnership with NVIDIA, and that is to develop some new technologies around AI platforms. And so we're up quite strongly there as well for Amkor.
Chloe, thank you so much. Chloe Mele will be back later in the hour. And also coming up this hour, we're going to speak about the tech sell-off and risk-on sentiment with Wei Li of BlackRock, the resurgence in energy prices and its impact on global yields as well, to the forefront of that conversation. But first, President Trump rebuilding his tariff wall with new levies on 60 economies to prevent alleged forced labor in their supply chains. U.S. Trade Representative Jamieson Greer writing in a statement, quote, "The United States has had a forced labor import ban for nearly a century and rigorously enforces it. It's well past time for our trading partners to do the same." Joining us now is Bloomberg's Brendan Murray. Brendan, are there no countries on this list that don't enforce a forced labor ban?
Well, that's what the U.S. administration says, is that all of these countries, some 60 plus the European Union, have some sort of lax enforcement or no regulations to prevent forced labor to appear in their supply chains and in the imports into their own countries. And so this measure has been in the works for a couple of months now, and what we're seeing now is the implementation, and it's really the first step of the administration's efforts to rebuild this tariff wall that the Supreme Court struck down back in February. The Supreme Court took away President Trump's favorite tool, but he has these other authorities that we're going to see come out throughout the months ahead. He's also used one recently this week against Canada that no one has ever used before, threatening a 50% tariff on Canada. So a lot of the uncertainty still will linger around this area of global trade because we don't really know exactly when or what level these tariffs are going to come in.
Yes, and there are exclusions from these particular tariffs, so imports of fuel, foods, fertilizers, also some, other products like automobiles and anything that's covered by NAFTA, so a lot of exclusions. What about individual countries? Will they start asking for exemptions, and what will they have to offer for that?
Well, the line is already starting to form from countries. We've got reactions from a number of them today, from Europe, across Asia, and this will feed into the administration's efforts to try to bring countries to the negotiating table. It will add leverage on the U.S. side to encourage these countries to open their markets, to lower their barriers to American exports, and to negotiate the kind of trade deals that the president has struck so far. The U.S. Trade Representative Jamieson Greer appeared before Congress this week. He says there are 19 of these so far, so there's a lot of work yet to be done, but what we're seeing is the administration sort of brick by brick trying to rebuild this barrier around the U.S. economy to accomplish their goals, reshoring U.S. production, a revival in manufacturing employment, and ultimately to raise revenue for the Treasury.
Brendan, thank you so much. That is Brendan Murray, our trade czar in London. President Trump also sending a stern warning to Iran, telling Axios in an interview, quote, "I am considering a massive attack, bigger than ever before. I am close to making a decision. We are all set for it." Bloomberg's Onur Ant joins us now for more. Onur, if the president is serious, and he has carried out attacks, obviously, 13 consecutive days of them, would he need a new catalyst, or does he have enough already to make that military strike?
He probably doesn't need a new catalyst, but if he needs one, he clearly singled out what it would be. He said, he has been saying that Iran should stop attacking maritime shipping through Hormuz. But what happened earlier this week was that not Iran, but a group backed by Iran attacked ships not in Hormuz, but about 2,000 kilometers away in the Red Sea before those ships were supposed to exit the area through another choke point called Bab al-Mandeb. So that had created some confusion as to whether that would qualify as a trigger for further U.S. retaliation. And President Trump yesterday clarified that very openly. He said any shipping attack in the area, be it by Iran or any other groups that it supports, will be considered a fault or a mistake by Iran, and it could result in further escalation and retaliation by the U.S. So yes, in essence, he doesn't need a catalyst, but if he needs one, he clearly made it very clear what that catalyst would look like, and that's any attack on shipping in the Middle East, be it in Hormuz or Bab al-Mandeb Strait.
You know, Owner, when the Strait of Hormuz was being blockaded by Iran, after a while, President Trump turned around and decided that the US could also do that, could also blockade on the other side, right? Can it do anything like that on the Red Sea side of Saudi Arabia?
Well, that would be quite a stretch. First of all, there is not much to blockade on the other side, because in the case of Hormuz, he pledged to blockade Iran, whereas in Iran Bab al-Mandeb, he would only be blockading Yemen, which doesn't have the kind of oil exports that Iran has or relies on. So there isn't really that same cost or benefit dynamic that could go into that kind of blockade. And probably equally importantly, the U.S. military is already stretched in the area, in the region. So it's hard to imagine a scenario where it can successfully blockade, for whatever reason, another country that's about 2,000 kilometers away from the Strait of Hormuz.
Owner, thank you so much. That's Owner and our managing editor for the Middle East and North Africa. Now to other top stories trending on the terminal this morning. Bloomberg sources say SpaceX has started turning away satellite operators seeking rides on its Falcon 9 rocket beyond 2028. SpaceX has said it plans to transition Falcon 9 for Starship. Starship is central to Elon Musk's ambitions to put data centers in space. The company declined to comment. Volkswagen cut its revenue outlook for this year, saying it could decline as much as 3%. The automaker is expanding in Europe to counter slumping sales in China. Volkswagen still expects earnings to improve in the second half of 2026. The CFO spoke to Bloomberg.
We introduced about 20 new models this year and another 20 new models next year in various joint ventures. And with this setup, we want to achieve in the long term 10 to 11% market share in China.
Euro area business activity jumped to a 5-month high. The S&P Global Composite PMI rose to 51.9, moving back into growth for the first time since March. Germany also returned to growth while France's downturn eased. S&P Global warned renewed tensions around Iran could still weigh on the outlook. Coming up, Intel shares higher in pre-market trading on a blowout revenue forecast. We'll examine next. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. Shares of Intel higher in pre-market trading after its revenue forecast shattered the street's estimates. The chip maker looking to keep capitalizing on the AI boom. CFO David Zinsner told Bloomberg, quote, "We'll be increasing our capex from about $18 billion to $20 billion for this year, which will then mean it's up year over year. When we came into the year, we thought it would be down." Bloomberg's Neil Campling joins us now. Neil, incredible. How did Lip Bhutan and his team position Intel so quickly to benefit so much from the AI revolution?
Yeah, it's a great question, Bonnie, because we know from historically the company has struggled with execution. So firstly, they have turned this around in terms of executing to plan, which is a great relief. The second aspect, and the reason why Intel are benefiting from this, is what's happening in terms of the AI workloads. Because we're now moving away from training models, if you like, and now moving into really the key growing workloads, they need a lot more CPUs, the core processing unit power, which of course is the bread and butter of Intel's business. So we're seeing a massive renaissance really of the CPU demands, and that's coming through in terms of Intel's growth and Intel's revenues and the ability to have the confidence to raise that CapEx guidance, as you mentioned. So that's really positive and playing out for them. And the other thing to think here in terms of the geopolitical dynamics that are at play, that, you know, the only US-based leading edge maker of the actual chips is Intel. So that clearly plays into another key positive for the company, despite the fact that we've got, you know, other concerns in other areas of the AI trade with the Mag 7, etc. And, you know, I saw somebody called out the Mag 7 as a malignant 7 this morning.
Oh,
well,
yes.
this is a way of benefiting from that, that's for sure.
It does feel like a group of the past at this point. Neil, I do have a question though. Why do none of these companies disclose who their clients and what their contracts are? Lip Bhutan himself just talking about multiple engagements. He wouldn't say who, what, where, when.
It's either a question of the competitive arrangements in terms of not wanting to let secrets out as to what kind of form factors the deals might be, whether it's based around the NVIDIA ecosystem or an AMD system or the Google TPUs, those kind of things perhaps. Or is it perhaps because of some of these circular deals that are concerning some investors that are taking place where NVIDIA's been funding some of its neo cloud partners, etc. So it's certainly something that we'll be looking to get more disclosure on going forward. But for now, yeah, it is one concern to be aware of for sure.
SAP's cloud growth also extremely impressive and really helping Europe massively today. What has SAP done?
I think if we came into the print, then there was real concern that they might do should we say, an IBM. What IBM said in terms of the stalling of spending from clients, that could come through in SAP. They didn't see that. Their bookings growth is very strong. So that's a relief rally for sure for SAP for the time being. So I think that's very, very good news for European investors for worried about the kind of maybe the Anthropics of the world where clients may be spending on their tools. The core business for SAP is still in high demand. So there's definitely a relief there. And I think for investors, they're going to be looking to see what Microsoft say next week. That's the real, I think, key bellwether for the next move in the software complex.
Well, several stocks higher this morning. It remains to be seen if the broader tech sector will be up or if some parts of it will be dragging the tech sector down. Neil, thank you so much. Neil Campling there in London for us. Coming up, Meta facing higher than expected borrowing costs for a new data center. More on that and what else is making headlines in your front page news. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. This week on Bloomberg Wall Street Week, we take a look at housing affordability in the United States. There's one major city where that appears to be making real progress, while others are still struggling.
The city itself was adding about $10,000 a month to the cost of a single-family home. And it was causing more than $500,000 a month to multifamily. Well, you can't out of one side of your mouth say you're for affordability and out of the other side of your mouth be getting in the way. And then of course the second big area is land use itself and how we make it so that people can use the land and build what they need to build. We came in and through what we called our home initiative, we changed that to allow by right 3 units on even a single family zoned lot. And then the second thing we did is change the minimum lot size. In Austin, our minimum lot size when I came into office was 5,750 square feet. That was the minimum lot you could build on. Well, what that means, if you got to have that big a lot, then you're going to need to build a big house. You're going to need to build a McMansion. But if you have the ability to have 3 by right and you reduce the minimum lot size, which we did, to 1,800 square feet, from 5,750 to 1,800. Now you can start building what I was talking about a minute ago, those starter homes. You can build smaller homes and it makes economic sense. The market can react to that in an appropriate way.
Wall Street Week's Simon Hampton joins us now at the desk. So it sounds like Austin did find some solutions, but what made the situation so urgent in Austin in the first place?
Well, it all started in the pandemic. A lot of us were working from home, and a lot of people went to Austin. A lot of businesses moved to Austin. So there was a big influx of people around 2020, 2021. And rents, I think, increased around 25% in a single year. That was one of the biggest increases in the nation. So the advantage of that, I guess, is that the mayor there, you heard there, Kirk Watson, he really had support from both sides of the aisle to do something about housing. And so he got buy-in from everyone, and really he was able to turn things around and change a lot of zoning rules, change permitting, make things a lot easier for developers to bring supply online. And between 2023 and 2024, they built around 50,000 units. Wow. So they brought in a lot of supply, and then since then, they've now seen rents declining from that 2021 average by about 19%. So the supply comes online and affordability
Yeah, the economic effect is literally follows right after. Yeah. Can other cities replicate some of the things that the mayor was talking about?
I think they probably want to cherry pick some things. Maybe you take Manhattan, for example, which is certainly receives a lot of focus around affordability, and with Mayor Mamdani's rent freeze, an unpopular move with landlords at the moment. You compare Manhattan and Austin. Well, you heard there the mayor talking about the average lot size of 5,750 feet before they made the changes.
Yes.
It's a lot more than a Manhattan apartment.
Would we have that luxury in Manhattan? Bloomberg's Simon Hampton, thank you so much. Do tune in to tonight's edition of Wall Street Week. It's at 6 p.m. New York time. Coming up, we'll speak with Wei Li of BlackRock. It's 5:30 a.m. in New York City, 10:30 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Futures slightly higher after the Mag 7 suffered its biggest one-day drop since the tariff-driven sell-off in April 2025. Fresh U.S. levies taking effect on goods from 60 economies as President Trump rebuilds his tariff wall. And Brent crude below $100 a barrel now, having topped it after President Trump says he's mulling a massive attack on Iran. Let's take a look at those markets then, and oil well down now. We have Brent crude, a positively calm 96.78 a barrel. Now, I'm being slightly sarcastic because obviously that's not a good figure to see. We heard that yesterday with Christine Lagarde being extra hawkish at the ECB pretty unexpectedly, or at least she wouldn't have expected that she would need to be. But that run up in oil is still pretty massive. We saw a more than 30% run up in Brent this month alone, and obviously yesterday we did top 100 a barrel, so whatever is calming this market is certainly having an impact. WTI as well below $90 a barrel once again, so down a good 3+%. No relief though for European gas futures, where we're really seeing some pain. 62.29 per megawatt hour now in terms of euros, and that is a really stunning incline for European gas futures. Obviously, there's a whole lot of pain about to be felt in Europe, and storage is really getting massively depleted as well. This is a time where normally Europe would be rebuilding inventories, and they haven't been able to as fast. They're only rebuilding them ever so slowly. Inventories usually around 70% full at this point. Now they're only just more than 50% full. Let's take a look at the US futures picture, because we did see that pretty massive drop yesterday, even with some positive earnings stories after the close, like Intel, for example, really cheering the market. Now, futures started off deciding which way to go, because we had a down session in Korea overnight and the chip sell-off continued there. However, it does appear that futures are going their own way here in the United States and rising once again. Let's look at yields, because that's also the massive story, particularly, well, the whole curve actually. We have the 2-year yield being extra volatile and well above 430, a massive rise in just a few sessions, and the 30-year yield continues to elevate. It's really just under 517 now. We had a tips auction yesterday that also saw poor appetite, so investors seem to be waiting for more basis points to get put on this trade before jumping in. All right, let's get to some individual market movers. Pre-market now. Back over to London and Chloe Melee.
Good morning, Bonnie. We are seeing Intel up about 4% in pre-market trading this morning after this much stronger than expected revenue forecast, which of course signals this very sustainable, strong AI demand, and also seems to indicate that the turnaround of the company is making progress and is starting to pay off. And so we're up quite strongly this morning for Intel in pre-market trading. Moving on to another tech company, we've got the semiconductor device company MaxLinear down quite significantly this morning, more than 10%, after earnings came in only slightly ahead of expectations, and that was just not quite enough to sustain the massive rally, a more than 400% rally that we had seen in those shares since the beginning of the year. And finally, let's end with one last tech stock. We've got Amkor this morning signing a multi-year $1.5 billion partnership with NVIDIA to develop a semiconductor, advanced semiconductor packaging, and also testing some new technologies around those AI platforms. And so this is really driving the stock this morning, and we're up almost, well, actually more than 11% this morning for Amkor.
All right, Chloe, it is going to be a very interesting Friday trading session. Thank you so much. Futures edging higher after stocks notched their biggest drop this month. Wei Li of BlackRock keeping the faith, though, sticking with stocks, writing, quote, "We prefer US equities over long-term government bonds, so long as earnings growth remains exceptionally strong while offsetting higher interest rates." She's Global Chief Investment Strategist at BlackRock and joins us now. Wei Li, characterize this earnings season for us. We've seen some massive disappointments, even if companies did surprise to the upside, and some massive outperformances, even when companies just did what they're supposed to do.
That's right. Good morning. What we have seen so far in the earnings season is that the sellers of scarcity are doing much better than buyers of scarcity. But the bigger picture remains that earnings expectations are very strong and elevated. So expectation for 26 this year, earnings growth for S&P 500 has grown to 25% from just 18% 3 months ago. So momentum is very strong, but increasingly it's not just about kind of the levels, but also durability of earnings, which is why kind of looking just beyond the next quarter is important, especially in the context of some of the cheaper models also becoming very good, potentially impacting the economics of AI and also how rent can be captured, especially in the intelligence layer. So specifically for this earnings season, I am looking for earnings durability. I'm looking for companies' commitment for CapEx, but also how they balance that with discipline, CapEx discipline, and also importantly, in the face of cheaper models becoming very good, how management is dealing with cost pressure and cheaper model deployment, and also in particular AI sovereignty, which is becoming a bigger consideration.
Yeah, absolutely. I think that's definitely going to be the next question. Wei, when will we know whether hyperscaler returns justify the capital outlay? Is there a company that will elucidate that for us, or a subsector of the AI trade?
I think we don't know yet, because it does take time for investment to then lead to new revenue creation, which is why in our media outlook, we try to focus on the scarcity, the bottlenecks, rather than betting on winners and losers. But for this earnings season, we are paying attention to revenue creation, earnings sustainability too. You know, we are looking at cloud revenue to get a sense, a hint of if some of the investment is paying off. But the bigger question about all this close to trillions of AI CapEx spend, when they are going to bear fruit, I think it's just slightly too early to say, which is why we are betting on the infrastructure layer, because even as models become cheaper, accelerating adoption can still create additional demand. But also, again, AI sovereignty, companies and countries wanting to have greater control over their own AI, wanting to rely less on foreign infrastructure. All of that leads to greater demand for infrastructure, which is how we want to play this.
Well, Wei, the thing about scarcity is that it's only scarcity if demand outstrips it, or close to outstrips it, right? And I feel like an investor has to really have the faith that these companies will see the pledges delivered upon, right? OpenAI and Anthropic pledges. I mean, will that happen? You know, could there be a problem down the road where those commitments aren't actually met in the end?
There is definitely a risk on the table. Right now, we're still in an environment where there are multiple scenarios, each very different from each other. They're all on the table. We call this environment a polyfaceted environment, which is different from before, where, yes, we have multiple scenarios on the table, but they follow a bit of a central case. Right now, there's no central case anymore with AI transformation and some of the other mega forces. So one thing that we are paying attention to going beyond just this earnings season is the revenue ramp of this leading model labs. You know, like we have seen incredible eye-watering revenue ramp, increasing ARR from likes of Anthropic and OpenAI. Earlier this year, momentum continues. If that continues, is going to be key, especially in the context of cheaper models, open source models becoming also very good. So the risk of commoditization is indeed important in terms of revenue capture for these model labs. But again, that impacts more on the rent capture of the intelligence layer rather than questioning the whole AI thesis.
Yes.
The infrastructure build, that layer we do not think is impacted by more models coming online that are also becoming very good.
Wait, I have to ask you about yields, right? Because even you are so positive stocks in spite of what you call a fragile world, right? There are so many challenges out there. Tariff risks are back. War risks are absolutely back just in the last week. The oil price shock, obviously, as a trickle down from that. And we've seen yields pretty much skyrocket, right? I mean, at their highs of the year and maybe even 2 years for some parts of the curve. And it's not enough to entice investors back. Investors seem to be still looking at the AI trade, as are you. Explain to me why that makes sense.
Yeah, so this is really interesting and delicate. So I always get a bit nervous heading into summer because investors want to square their book and liquidity is a bit thinner. So these are the technical factors that could drive market volatility. But in the rates space, it feels that it is more than just the technical factors that are driving yields spiking higher and volatility increasing. It feels a little bit more fundamental, and it's really the result of the two developments that you talked about. One is this prolonged supply disruption leading to higher inflation expectations and higher rates. And the other one is AI build out, increasing competition for capital, pushing up rates, not only nominal rates, but also real rates. So what we have seen in the rates yield space feels more fundamental. And this is something that we have been talking about for a while, the increasing competition for capital, pushing up real yields. So that is happening now. And we actually think that there may be more to go. It's a great place for income. So durable income is going to be an even more durable theme in portfolio. But definitely this is why we have preferred equities over government bonds.
I didn't get to ask you about the Fed. We'll have to ask you after the Fed meeting. Wei, thank you so much. Wei Li of BlackRock joining us this morning. Now to all the top stories trending on the terminal. Bloomberg sources say SpaceX has started turning away satellite operators seeking rides on its Falcon 9 rocket beyond 2028. SpaceX has said it plans to transition Falcon 9 for Starship. Starship is central to Elon Musk's ambitions to put data centers in space. The company declined to comment. US regulators will start developing new requirements to make sure drivers and passengers can safely exit their vehicles. The move comes after at least 15 deaths occurred in which car occupants couldn't open the doors of a Tesla that had crashed or had caught fire. The World Cup, staycations and scorching weather helped Britain's private sector bounce in July. S&P Global UK PMI data rose to a 3-month high. It came in at 52.1, a sharp increase from June. The hospitality sector was the biggest beneficiary, with pubs boosted by England's run to the World Cup semi-finals. Coming up, global tariffs are back. President Trump makes his biggest move yet to reconstruct his levies after being struck down by the Supreme Court. This is Bloomberg. This This is Bloomberg Brief. I'm Bonnie Quinn in New York. President Trump putting his tariff wall back up. Fresh levies, two straighter, 10% and 12.5% on goods from about 60 economies, and they took effect overnight. Let's get more with Jonathan Tamari of Bloomberg Government in Washington. So the administration found a way, Jonathan. Is this a permanent, legally compliant fix?
It's certainly more long-lasting than the tariffs that just expired that had a specific time limit on them. As far as how much this stands up in court, I think it's going to be tested. It certainly is, again, it doesn't have the time restrictions as the other one, but I think that you'll certainly see people testing whether or not this actually complies with the law. The fact that these tariffs rolled on at the exact moment that the old ones rolled off, I think will be something that will be tested about whether this was a legitimate investigation and a legitimate use of the law.
Many products are not included, right? And there's also products that fall under NAFTA agreements that aren't included. And of course, Trump has also threatened tariffs on various subsectors and so on. So this isn't the end of the story. At the same time, countries will likely be trying to at least get around some of these tariffs, if not retaliate. Is the administration planning that there won't be any retaliation given what happened last time?
I mean, I think they need to expect that there will be retaliation, and they've experienced that already. And I think often we see, not always, but often we see that when the president's first moves are often just for leverage, for negotiating. We know that this week, for example, he also announced he was threatening the possibility of 50% tariffs on some things from Canada. And most people in both countries say that that's probably something that he's trying to use to bring Canada to the table for renegotiating the U.S., Mexico, Canada trade agreement. And so I think that there's a chance that some of this is more leverage for the president, but some of it is that this is his signature economic policy. It's something he really believes in, and that he's doubling, I guess, tripling down on. This is his third attempt to put this in place after the Supreme Court knocked down the first one, and then his second effort had a legal time limit on it.
Moving to Iran, Jonathan, so obviously the president says he's weighing wider Iranian attacks. He said that before, but this time he seems to really be planning on escalating in a massive way. That was literally the word he used. You know, the cost of the war is increasing. There's an official count now of 17 bodies, right? As well as all of the munitions and the depletion of resources that are already, you know, going to two wars to help other parties. Will the president get a good response from anybody if he makes a massive strike on Iran?
There's not a large appetite that we're seeing in the American public, in Congress, for escalating this war. The war has been unpopular in public polling since it began. Members of Congress have not been consulted. They have very little say in it. There's a lot of frustration about that. The House, which, as you know, is controlled by Republicans, just for a second time passed a resolution to try to rein in this war. It was mostly, to be fair, Democrats supporting that, but there were 4 Republicans who crossed over. And remember, we are heading into the heat of election season. And when you talk about tariffs that have the potential to increase costs, a war that much of the public doesn't like and is also increasing gas costs, those things are not great for Republicans who are campaigning right now. So I don't think there's a lot of appetite for it, but we have not seen any serious moves from Congress to rein this in. And so there's a lot of complaints, but not a lot of action. I don't think there's a lot of support for this move, but the president seems to be out of maneuvers as he's failed or not been unable to reach an agreement with Iran.
Jonathan, thank you so much for all that context this morning. That is Jonathan Tamari of Bloomberg Government. Turning back to tech now, and shares of Intel jumping after the chipmaker's guidance blew past analyst estimates. CEO Lip Bhutan telling Bloomberg, quote, demand is outpacing our increasing supply, and so those are good problems to have. Let's get more with Matt Bloxham of Bloomberg Intelligence. Matt, what is Intel suddenly doing so right?
Yeah, maybe it's not so much what they're doing right, but the way the market is moving, particularly in AI. So, you know, we went through a long phase where the investments were squarely focused on GPUs, the kind of chips that NVIDIA builds. and that was because the market was focused on training the big models. And because the market's now shifted towards actually deploying and using AI, particularly in a corporate environment, then you need a lot more of the kind of general compute, so CPUs, which is Intel's strength. And so I think the market's kind of shifted back towards where Intel really has strong capabilities. And yeah, as we heard there from the CEO, they've been expanding capacity alongside that, so they're more able to kind of match the demand that's out there.
But also, Matt, I mean, it's been a bit of a land grab, right? And Intel seems to have been able to ramp up really, really quickly and grab those clients, or as Lip Bhutan calls them, multiple engagements, whatever that means.
Yeah, so I think this kind of flips a little bit into the foundry market too. So, you know, they're in parallel to their kind of Intel-branded chip business, they're also building a foundry business, which is basically them contract manufacturing chips for other parties. It's still a kind of growing business, still at kind of very early stage, but they've got one public customer in Fortinet and a number of other companies that are evaluating the product quite closely, and perhaps the most interesting of those is SpaceX, together with Tesla and their Tariffs initiative, who may well use Intel as a significant contract chip manufacturer. So I think, you know, in both these areas, the business has got really good positive momentum. We heard today that they're planning to increase their capital spending. Historically, they've been cutting capital spending, and obviously now we saw a negative reaction to CapEx increases at Google earlier in the week. But I think Intel's coming from a very different place, and I think that's a strong signal of confidence in the forward book of demand that they have.
Yep, an important note to make there. And Matt, you know, it looks like Intel is going to add to its 171% gain year to date. That's just year to date today in today's session. Matt Bloxham of Bloomberg Intelligence, thank you so much. Coming up, we're going to get you set up for your trading day with more earnings and economic data on deck. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. 6 contenders vying to be the next United Nations Secretary General made their cases at the UN headquarters here in Manhattan. Here's a part of the town hall.
Our responsibility is to make the UN relevant again, to deliver, to touch the hearts and souls of people on the ground.
Moral authority is always needed, and you always need to speak out on the issues where violations of human rights have been.
What we need to do is to restore this credibility of the UN as a valid interlocutor.
I would like to see a UN that is back at the table in the scenarios of conflict. I would like to see a UN that has rebuilt trust.
The UN must be more present, especially in the peace and security arena, that we would have moved from where we are today to a UN that is delivering better in peace and security.
Global security, peace and stability is something that is incumbent on the Security Council, and the lack of trust between the members today, particularly between the permanent members, is that means that crises go on without solutions being found.
And that was part of the UN Town Hall. Now, a look at what's ahead for this Friday's trading session. Well, we get earnings from SLB and American Express before the bell. And then we get data, US PMIs at 9:45 Eastern, followed by new home sales at 10. Plus, President Trump slated to participate in the rescheduled White House Correspondents' Dinner tonight. That takes place at 7 p.m. in Washington. Some micro movers before the bell now. Obviously, Intel extending post-earnings gains as its blowout outlook underlined AI demand. MaxLinear down 10%. Results failed to sustain the strong rally so far this year. And Amkor Tech rising pretty substantially after the firm announced a $1.5 billion deal with NVIDIA. Let's take a look at your macro picture, though, on this final session after a really bumpy week and ahead of what could be an eventful weekend. We do have NASDAQ futures pointed higher, Brent crude coming down, and the 30-year yield at its highs close to them.